Good morning, everyone. Today is Monday, April 20th. Let's talk about what's driving mortgage rates this week and what you should actually be doing about it. The big story right now is not just inflation, not just the Fed, it's geopolitical risk, specifically the ongoing Iran conflict and what it's doing to oil prices and the bond market. Here's the connection you need to understand. When tensions escalate in the Middle East, especially around the Strait of Hormuz, which moves roughly 20% of global oil supply, oil prices spike. When oil spikes, inflation expectations rise, bond investors demand higher yields, and mortgage rates move up. That's exactly what we've been seeing. Oil has been extremely volatile this week, with recent headlines pushing crude back toward the mid 90s range and higher. And every time that happens, it puts upward pressure on the 10-year Treasury, which has been holding in that 4.2% to 4.4% range. Now, here's where it gets interesting and where opportunity comes in. We've also seen moments of rate relief tied directly to ceasefire headlines. When tensions ease, even temporarily, oil drops, inflation fears cool, and rates improve. That's why mortgage rates have been bouncing around the low to mid 6% range instead of continuing to spike higher. So, this is not a normal market. This is a headline driven rate environment where a single geopolitical development can move rates more than an entire economic report. What this means for loan officers. First, you need to reframe how you talk about rates with clients. Rates are not just about the Fed anymore, they're about global events. That actually helps you because it explains why waiting for the perfect rate is not a strategy. The truth is, even if rates improve, it may be temporary. And if the conflict escalates, rates can move higher quickly again. So your job is to shift the conversation to how do we structure the right deal today? Not should we wait for rates to drop. Second, this is a volatility advantage if you use it correctly. When rates stabilize, even briefly, you get windows where borrowers feel more confident. That's your moment to act. This week, I would be calling every pre approval from the last 30 to 60 days and rerunning numbers with current pricing. I would also be showing side by side options, current rate versus buy down versus refinance strategy, because the borrower who understands their options is the one who moves forward. Third, this is a realtor leverage market right now. We're seeing more price reductions, more hesitant buyers, and agents struggling to keep deals together. That is your opportunity. Your message to agents should be I can help you convert more of your buyers by structuring deals that actually work in this rate environment. That means seller paid buy downs, FHA and VA positioning, and creative structuring. This is where deals are being won right now. Bottom line, the market right now is being driven by oil, inflation expectations, and global conflict, not just traditional economic data. And that means one thing: speed and strategy beat rate predictions. The loan officers who win in this market are not the ones waiting. They're the ones reworking files, communicating clearly, and staying in front of their clients and agents consistently. Because when the market gives you a window, even a small one, you're ready to capitalize on it.
If you're a loan officer and you're looking for a better way to navigate this market with stronger tools, better systems, and real support to grow your business, reach out to me. I'd love to show you what we're building at Central Coast Lending and how it can help elevate your production. My contact information is on the screen, and I'd love to hear from you.